If you are self-employed and you did not pay estimated taxes last year, the IRS has already assessed an underpayment penalty on your account. You do not receive a warning. You do not receive a bill mid-year. The penalty accrues silently quarter by quarter at an annualized rate of 8% as of 2024, and it appears on your tax return when you file. The average freelancer who misses all 4 quarterly payments on $70,000 of net income owes roughly $600 in penalties before they owe $1 of the actual tax. This is avoidable with a single calculation. The requirement exists because the American tax system is pay-as-you-go. W-2 employees have tax withheld from every paycheck automatically. Self-employed individuals have no employer to withhold on their behalf, so the IRS requires them to estimate and prepay tax 4 times per year. The legal basis is IRC Section 6654. The penalty is not based on your total annual underpayment. It is calculated separately for each quarter, meaning missing an early payment costs more than missing a late one, and catching up in December does not eliminate the penalty for quarters 1 through 3. The 4 quarterly due dates are not evenly spaced. Quarter 1 covers January through March, payment due April 15th. Quarter 2 covers April and May, payment due June 15th. Quarter 3 covers June through August, payment due September 15th. Quarter 4 covers September through December, payment due January 15th of the following year. Notice that Quarter 2 covers only 2 months, while Quarter 4 covers 4. Missing the June 15th payment, which many freelancers do because they are focused on the April filing, triggers a disproportionately large penalty relative to the short quarter it covers. The formula begins with your expected total tax liability for the year. That is your estimated federal income tax plus your self-employment tax. Divide that figure by 4 and pay that amount each quarter. If you expect $20,000 in total tax liability, each quarterly payment is $5,000. Simple in principle. The difficulty is that most self-employed people do not know their annual income until December. That uncertainty is exactly why the IRS created a safe harbor rule that eliminates the underpayment penalty entirely regardless of what you earn. Safe Harbor Rule 1. Pay at least 90% of your current year tax liability across the 4 quarters. If you owe $20,000 for the full year and paid $18,000 in quarterly installments, no penalty applies. Safe Harbor Rule 2, and this is the one most tax professionals recommend for variable income freelancers. Pay 100% of your prior year's total tax liability. If your 2023 total tax was $15,000, pay $15,000 spread across 2024 quarters, $3,750 per quarter, and you will owe no underpayment penalty regardless of how much you earn in 2024. For earners over $150,000 in adjusted gross income, the prior year safe harbor rises to 110%. The mechanics of payment are straightforward. The IRS prefers electronic payment through IRS Direct Pay at IRS.gov or through the Electronic Federal Tax Payment System, EFTPS, which requires advance registration but allows scheduled payments. You can also mail IRS Form 1040-ES with a physical check made payable to the United States Treasury postmarked by each deadline. Keep every confirmation number from electronic payments or every post office receipt from mailed payments. These records are your proof of timely payment if the IRS ever questions the dates. For freelancers with highly variable income, the annualized income installment method found in IRS Publication 505 and calculated on Form 2000-20010 allows each quarterly payment to be based on the actual income earned in that quarter rather than a flat annual estimate. If you earn $5,000 in Q1 and $45,000 in Q3, your Q1 payment is calculated on $5,000 and your Q3 payment on $45,000. This prevents the common scenario where a slow start freelancer overpays early quarters or underpays late ones. It requires more calculation, but it perfectly matches payments to actual earnings. State estimated taxes operate on approximately the same schedule as federal. Most states align their quarterly due dates, but the rate and calculation vary significantly. California, for example, uses a non-standard schedule: 30% due April 15th, 40% due June 15th, 0% in September, and 30% due January 15th. If you are a California resident and applying a standard 25-25-25-25 split to your state payments, you are doing it wrong. Always check your state-specific instructions. They are not identical to the federal calendar or weighting. The most practical approach for a first-year freelancer uncertain about annual income: use the prior year safe harbor from day one. Take your last W-2 year's total federal tax from line 24 of your prior Form 1040, divide by 4. Pay that amount on each due date. This guarantees no federal underpayment penalty. Then, when you file your return, if you earned significantly more than expected, you pay the remaining balance as a lump sum with no penalty because the safe harbor protected you. In year 2, update your quarterly amount to match the new prior year's liability. Quarterly estimated taxes are not complicated once you understand the safe harbor. Pay 100% of last year's tax liability, or 110% if your prior AGI exceeded $150,000, in 4 equal installments by April, June, September, and January. No penalty, no surprises. The actual amount you owe gets settled at filing. If you want to understand how to reduce that annual liability through proper retirement account planning, our video on SEPIR, I versus Solo 401k, which retirement account is right for your income level, covers the exact rules. Paying the right estimated amount keeps you penalty-free. Lowering the number you owe in the first place is a different lever, and retirement accounts are the biggest one. If this helped, SEPIR I versus Solo 401k, which retirement account is right for your income level, goes further. It is on this channel.